All right, let's talk about Brazil. Specifically, let's talk about the risk of investing in Brazil. You see the headlines, you see the numbers, but what are they really telling you? We're going to dig into a really fascinating risk analysis from April 2025 that shows what those surface-level figures might be hiding. Let's get right into it.
So where do we even start? I mean, how do you actually measure the risk of an entire country? It's a huge question, right? And, the market has its standard answers, its go-to metrics, but are they telling us the whole story? That's what we're here to figure out.
Okay, so first things first, what even is Risco Brasil, or Brazil risk? It's not just some vague feeling. In the world of finance, it's a number, it's a price. Think of it as the extra fee, the premium that investors demand to put their money into Brazil compared to, say, a safer bet like U.S. government bonds. It's the price you pay for navigating all the question marks around Brazil's debt, its currency, its rules, and inflation.
Now, this is how the market usually tries to slap a number on that risk. They have these three main thermometers. You've got the EMBI+, which basically tells you how much more interest Brazil has to pay on its debt than the U.S. does. Then there's the CDS, which is essentially an insurance policy investors buy against Brazil defaulting. And of course, you have the credit ratings from the big agencies like S&P and Moody's. This is the standard view, the stuff you'll see on the news every day.
But here's the kicker. Do these numbers, the ones everyone obsesses over, really give us the full picture? The analysis we're digging into today suggests, well, probably not. Not even close. You see, the problem with these popular metrics is that they can be, well, a bit deceptive. They can get pushed around by huge waves of global money that have absolutely nothing to do with Brazil's actual health. And here's the critical part. They often just look at the total amount of debt, but they can completely miss the quality of that debt, giving us a really incomplete and maybe even dangerous view.
And that brings us right to our first section, the market's blind spots. Let's pull back the curtain and look at the things that traditional analysis often just ignores.
Okay, just take a second and look at this number. 2.3 trillion reais. And no, that is not a typo. This represents the first huge blind spot, a hidden debt that's so massive it's kind of hard to even wrap your head around. So the question is, where on earth does it come from?
Well, it comes from this, a hidden debt bomb just ticking away inside the pension systems of Brazil's many states and cities. Now, this isn't on the main federal government's books, but you can bet it could become their problem down the road. And here's the thing, it's almost never included in the standard calculations for Brazil risk.
Now let's talk about another risk, something called fiscal dominance. This is a really dangerous feedback loop. Here's how it works. The government has a ton of debt that's tied to floating interest rates. So when the central bank does its job and raises rates to fight inflation, bam, the government's debt payments explode. This creates massive political pressure on the central bank to stop. The market sees this, loses faith in the bank's independence, and suddenly you're in a downward spiral, where risk premiums, the exchange rate, and inflation all just shoot sky high.
And this chart, wow, this chart perfectly illustrates another hidden risk. We're not just talking about financial debt. This is about time debt. Look at this. It takes a company in Brazil over 1,500 hours a year just to deal with its taxes. Compare that to the average of just 234 hours in developed countries. This massive burden, the famous Custo Brasil, or Brazil cost, is a huge drag on the economy and a major factor for anyone thinking about investing.
So, you see, when you start adding these blind spots together, the hidden pension debt, the threat of fiscal dominance, the crushing operational costs, the entire picture of Brazil's risk profile completely changes. You start to see these deep, structural vulnerabilities that those simple front-page numbers just don't capture at all.
So once you account for these hidden factors, you realize that two very, very different futures for Brazil start to emerge. Let's dive into these two competing stories for what comes next.
On one hand, you've got the optimistic, or bullish case. This is the story where years of quiet, structural reforms finally click into place. The government gets its finances under control, and the risk premium drops like a rock. Then you have the pessimistic, or bearish case. This is where that fiscal dominance loop we talked about actually happens. Confidence evaporates, and Brazil gets trapped in a cycle of a weak currency and painfully high interest rates.
Let's start with the good news. Why might Brazil surprise everyone to the upside? Well, the argument is that a whole bunch of smaller, under-the-radar reforms have genuinely made it easier to do business. If the new fiscal rules stick, government spending could gradually come under control. And Brazil is sitting on a massive cushion of over $350 billion in foreign reserves. If this scenario plays out, the risk premium could fall by 100 to 150 points.
But of course, there's the flip side. What could go wrong?
The triggers for the pessimistic view are pretty clear. The national debt is huge, around 88% of the economy, and its structure isn't great. There's a very real risk that spending gets out of control, especially with the 2026 election on the horizon. If that happens, market confidence could just crumble, and you could see that risk premium explode by 200, maybe even 350 points.
So, after looking at these two completely opposite paths, what's the big takeaway? What's the strategic lesson when we learn to think beyond the simple headline numbers?
And here it is. This is the most crucial insight. The market tends to paint with a really broad brush. It just slaps that single Brazil risk label on absolutely everything. The real analytical edge, the true value, comes from being able to tell the difference, to separate the companies and projects that are vulnerable from the ones that are structurally protected and can weather the storm.
You know, that April 2025 report we've been using sums it up perfectly with this quote. The available alpha lies precisely in the analytical capacity to make this distinction with rigor. In other words, the real opportunity isn't just betting on the country as a whole, but in doing the hard work of rigorously analyzing its complex moving parts.
Hey, if you found this deep dive insightful, and I hope you did, be sure to follow our channel, Macroeconomy IA. We do a lot more of these deep dives into macroeconomics, artificial intelligence, and technology.
We've got more content just like this coming your way very soon, so make sure you stay tuned for our next publications.
And finally, of course, the important disclaimer. Please remember, this material is for informational and educational purposes only. It is not, in any way, a recommendation to buy or sell anything. Projections can and do change, and past performance is never a guarantee of future results. Thanks so much for watching.